Good afternoon. This is Oliver Slow, Blue Line Futures, coming to you from the Chicago Board of Trade. Today is Tuesday, June 17th. We're doing this a day earlier than usual because the markets will be closed on June 19th. That is Thursday. So getting a jump start on things before we get into the markets. I do want to remind you, if you have not signed up for a free trial of our daily commodity commentary, head over to bluelinefutures.com. From there, you can sign up for the free trial. Select the markets that most interest you, whether that be grains and livestock, equities, energies, currencies, etc. Our team has a wealth of knowledge and puts together some great reports in-house each and every morning, delivered to your inbox and updated in the portal throughout each trading day. Now that we got that little plug out of the way, we can go ahead and get into the markets and some of the things that have caught our eye to start this week's trade. I think the biggest thing, equity markets, a very, very strong rally in yesterday's trade on the back of maybe some easing geopolitical concerns, but some of that getting walked back a little bit today. So we are seeing some weakness in the equity markets, giving back some of yesterday's gains. But all in all, if you zoom out, really hasn't been any technical damage that has been done yet. I think the biggest risk going into the back half of the week were to be if things do heat up in the Middle East. Potentially that leads to some sort of risk-off sentiment growing and you see a little bit more pressure, but all in all, it doesn't seem to be a massive concern at this juncture. Now over to the energy complex, that's obviously gotten a lot of attention as of late. $70 is the level that we talked about in last week's video as being kind of an upside target, an objective area, and that really representing the breakdown point from Liberation Day last month. It's going to be important to see if the market can now use that and defend that as support going forward. If it can, I think that there's some potential to continue to work higher. And we're seeing the crude market really hold that as support in the last two trading days and really just melting up through this afternoon session, which, going back to what I said about geopolitical fears potentially increasing, potentially there's a sign that there are some growing concerns that things will heat up. We got the peace talk rhetoric yesterday. Today, it seems like that is, again, all been walked back. So oil market going to continue to be a wild one. So buckle up and trade and manage risk accordingly. The CME group does offer a wide range of contract sizes, which is great. It used to just be the 1,000 barrel contract. They have since come out with a 500 barrel contract and a 100 barrel contract. So a lot easier access to the market, easier to scale in and out of positions if you're a smaller retail trader who doesn't want to take on the full risk of a 1,000 barrel contract. Now that we got through those markets, currencies have been on the move in today's trade. Matty Candlesticks put together a great piece yesterday afternoon in our portal in his daily From the Desk commentary. So I want to hear what he's got to say about that and what he's looking at going forward. Matty, take it away.
Thanks, Oliver. This is Matt Bresnahan, Senior Market Strategist here at Blue Line Futures with today's chart of the day, which is a 2-for-1. And if you had access or have access to the Blue Line Futures research portal, you would have seen this yesterday highlighting the potential selling opportunity that was set up in the Euro futures contract. And starting off, just to give you a baseline, what we were looking at predominantly to start was the dollar index. You know, the dollar index is trading at multi-year lows, 3-year lows to be exact, and there had been, pretty significant bullish divergence, but it wasn't confirmed until the 12th. So last week we had the first instance of confirmed bullish divergence, which is usually a pretty high conviction sign that market momentum may be changing hands, maybe turning over to the bullish camp. Further conviction can be drawn from that because we did have an extremely high volume day coming in on the low. Now turning over to the Euro chart, it was much the same setup, but the exact opposite side of the coin, where we're making new highs on consecutively lower and lower highs on the divergence, meaning bearish divergence in this instance. And again, on the new high that we scored on June 12th, we did have, relatively high volume. On the Euro specifically, the high volume day on the September contract actually preceded the high by a single day on June 10th. So what was the trade? What are we looking at here? What we're looking for is exogenous weakness in the euro being driven by a turnaround in the US dollar. We did see that materialize fairly substantially in Tuesday's trading session, and I will be covering more of the money flow and momentum segments in markets through relative rotation graphs and a myriad of other examples and charts. So if you'd like to see more setups that look akin to this one, give us a call or subscribe to our research here and now. Kicking it back to you, Oliver. Thank you.
All right, thank you for that, Matt. That is great information, and you and I sit next to each other at the desk, so obviously, this is something that we keep a very close eye on, is those currencies, as it has a big impact on a lot of different commodities out there, and we've been kind of talking about when is there going to be a reversion trade in some of these currencies, like the US dollar and the euro, and it seems like so far you've hit that one pretty darn good, and we're seeing that kind of reflected in some prices, I think, specifically the gold market. The gold market had a strong finish to last week's trade, got beat up yesterday, and has so far kind of struggled to find its footing amidst the geopolitical tensions rising. And I think a lot of that is likely due to the dollar kind of making a resurgence in today's trade, which has been a little bit more of a headwind than a tailwind as it has been here recently. So if the dollar continues to firm up, the euros trade a little bit weaker, I wouldn't be surprised to see that maybe not smack gold sharply lower, maybe it will, but at least be a headwind, where in the last several weeks to months it's been a strong tailwind for the market. So something to keep a very close eye on there. And talking about the geopolitical risks and the gold trade, being somewhat of a perma bull myself for the last many years, I can say that I'm really not a fan of how the market trades when you start to get geopolitics involved. You get the initial bump higher, which is what we saw last week, but it seems like more times than not over the last several years, when you get countries fighting and war, you get the bump higher, and then when nothing else really escalates from there, it dissipates very quickly, and then some, and it eats into some of the hard work that the market, the gold market, has done prior to any of that conflict really happening. So I'm not a big fan of that. I've been relatively bullish gold for the better part of the last 10-15 years at these prices, and with what we're seeing in the currency markets, it might be a cause for pause. I'd love a good pullback to buy some more physical and potentially look at some futures positions for clients as well. Now, wrapping things up, we'll move over to the ag sector. Grains, a little bit something for everybody today. Corn just seems kind of like a dead duck here. July futures under pressure. We've got options expiration on Friday, so I think you're seeing some long liquidation there. Well, where the deferreds gain ground, September, December, etc., all posted small gains. So a little bit of optimism in those deferreds down towards the lower end of the risk range. Soybeans on the verge of a breakout. We're about 5 to 8 cents away from breaking out. 1075 is going to be the big line in the sand for the November contract. If we can chew through that with some conviction and achieve consecutive closes out above there, I really think that you could make kind of a beeline towards $11. Now, with that said, you got to figure out what hat you're wearing. Are you a trader or are you a hedger? If you're a producer who is already long in the field against resistance, this is probably a spot to be a little bit more on the defensive end rather than hoping for a breakout. So you got to figure out what your objectives are in the market. It is not the same for everybody. If you have questions on how to play it, whether it be to the upside or to the downside, feel free to call our trade desk. We can help devise a strategy that is most suitable for you. And then lastly, the wheat market, kind of a stealthy move higher today, taking out the prior day's highs and kind of knocking on the door of its own breakout as well. So that's going to be a market to keep a close eye on. Wheat has been really pummeled over the better part of the last year and a half. Funds have been short for 2, almost 3 years, I think, at this point. So if we start to see some unwind in some of these commodities and currencies, short covering would be the unwind in the wheat market. And again, knocking on resistance, if we can get out above there, potentially that would be the catalyst that spurs that, just technical in nature. And wrapping things up in the cattle complex, cattle got hit hard on Friday, rebounded it all back yesterday, and then really sold it all back and then some in today's trade. And how people are trading futures intraday in this environment is kind of mind-blowing. These ranges are wicked. On a percentage basis, it's not really out of the norm, but when you get these contracts at, 210 fats and 300 feeders, that's a lot different than trading 120 fats. So the swings are very wide. The ranges are wide. The volatility is high, so manage risk accordingly on that front. We continue to keep a close eye on the options market. We believe that that's probably the best way to play it, whether you're bullish or bearish. As far as the cash market goes, a little bit conflicting reports in today's trade from what we were hearing, higher in the north, softer in the south potentially. And then all eyes on that cattle on feed report at the end of the week. We'll have estimates in our portal. If they're not there already, they will be shortly, so be sure to check that out. Thank you for tuning in, and we will see you all tomorrow. Remember, trading futures and options involves substantial risk of loss and is not suitable for all investors.